If you're new to trading, you've probably seen all the ads, the promises of secret strategies and overnight fortunes. But let's start with something real. This is a quote from a trader with a decade in the trenches, and it gets right to the point. This game is less about finding some magic formula and way more about survival and knowing yourself. So that's the big question, right, for every single new trader. The odds are, frankly, not in your favor. So how do you avoid becoming another statistic? How do you survive long enough to actually learn something? Well, that's what we're going to break down. First things first, we got to get a reality check. The idea of making money from your laptop is, well, it's incredibly appealing. But for most people who start, the reality is a really tough and often expensive journey. And just to give you a sense of the scale here, look at this number. That's the estimated number of active retail traders in the foreign exchange or Forex market alone. We're not even counting stocks or crypto. So you're not just playing against a computer screen, you're stepping into this huge global arena with millions of other people trying to do the exact same thing. So in an environment that competitive, your number one goal can't be to hit a home run. Not at first. It has to be survival. Your only job is to stay in the game long enough to figure out how to actually play it. So let's talk about the rules for doing just that. And this is maybe the biggest mindset flip you have to make. See, a profit goal, like I want to make 10 grand, is totally out of your control. The market's going to do what the market's going to do. But a process goal, something like I will follow my plan on 9 out of 10 trades, that is 100% in your control. You can't control the outcome, but you can always control your actions. And that's where true consistency comes from. This right here is the heart of survival. It's all about risk management. Look, you're going to be wrong a lot, especially at first. The only question that matters is, how much does it cost you when you are? If you only risk a tiny piece of your account, like 1% or even less, you can be wrong 10, 20 times in a row and still be okay. It's the big, oh no, I'll just hold a little longer, losses that wipe people out. You have to respect your stop loss. No exceptions. Okay, so you're focused on survival. Awesome. Now what? Well, you need some tools. And the two main ways people analyze markets, they're not enemies. They're just different tools for different jobs. Let's dig in. Here's a simple way to think about it. Fundamental analysis helps you decide what to trade. It's like looking under the hood of a car, checking the engine, the company's real financial health. Technical analysis, on the other hand, helps you decide when to trade. It's all about using charts to find the right moment to step on the gas. One tells you where you might want to go, the other helps you read the traffic. So let's grab a tool from the fundamental toolbox. This is a classic, the price to earnings, or PE ratio. It helps you answer a really basic but important question. Is this stock a good deal right now, or is it overpriced? The math is actually super simple. You just take the stock's current price and divide it by how much money the company makes per share. The number you get tells you how many dollars investors are willing to shell out for every single dollar of that company's profit. So a PE of, say, 20 means people are paying 20 times the company's earnings. It's a quick way to see if a stock is cheap or expensive compared to others in its industry. All right, let's look at the other side of the toolkit. Technical analysis doesn't really care about a company's earnings reports. It's all about reading the room. It's the psychology of the crowd, but painted on a chart. The whole idea is that all the news and feelings are already baked into the price, and human behavior tends to repeat in pattern. And the language of these charts is written in these things, candlesticks. Each one is like a little story from a moment in time. The thick part, the body, shows where the price started and where it finished. And those little thin lines, we call them wicks, show the highest and lowest points it hit. Green usually means the price went up. Red means it went down. Simple as. Now, when you put a bunch of these candles together, you start to see patterns. You start to see stories. Take this one. It's called a hammer. See that long wick on the bottom? That's telling you that the sellers tried to tank the price. They pushed it way down. But then, whoosh, the buyers came storming back in and pushed the price all the way back up. It's a sign of a fight, a sign that the buyers are taking back control. And then you've got its evil twin, the shooting star. It's the exact opposite story. The buyers tried to push the price to the moon, but the sellers just slammed it right back down. This suggests that the buying party might be over and the sellers are stepping in. See? It's all about who's winning the battle in that moment. Okay, you can memorize every financial ratio, every single chart pattern on the planet, but none of it, and I mean none of it, will matter if you can't master the market that exists between your own two ears. This is the final boss. This is where most traders lose the game. These are your enemies. That feeling of being a genius after a few good trades. The fear that makes you panic and sell at the worst possible time. The greed that whispers just a little more. And loss aversion. Oh, that's a big one. That's the one that makes you hold on to a losing trade, just hoping and praying it turns around. And you don't have to look far to see this stuff in the wild. Check out this comment from Reddit. This is overconfidence bias in a nutshell. One lucky week and suddenly you think you've cracked the code. The market has a very, very painful way of teaching you that you haven't. That skull emoji says it all. Now, loss aversion, this one is a beast. Our brains are literally hardwired to feel the sting of a loss about twice as much as the joy of an equal gain. And that emotional pain makes us do completely irrational things, like ignoring our own rules and holding on to a losing position way too long. And man, this comment, this is the painful aftermath of loss aversion, not cutting my losses. That's one of the most common and destructive mistakes a trader can make. You can just feel the regret in that post. That conviction comes from learning a very, very expensive lesson. So after all of this, the charts, the risk, the psychology, what is the actual end game? What's the goal? I'm going to tell you, it is probably the exact opposite of what you think it is. It's not about excitement or adrenaline, it's about being boring. Just let that sink in for a second. Good trading becomes boring. If you're on the edge of your seat with every trade heart pounding, you're probably just gambling. A real sustainable trading process isn't a roller coaster. It's the methodical, disciplined, and, yeah, sometimes kind of boring execution of your plan over and over again. So how do you get to boring? Well, it's not a secret, it's a process. First, find your corner of the market. Don't try to trade everything. Just master one or two things. Second, you have to journal every single trade. Write down why you got in, why you got out, and, this is crucial, how you felt. This is how you find your weaknesses. Third, just execute your plan. And fourth, review your data, find what works, and do more of that. Repeat. That's it. That's the job. And that brings us right back to the beginning and to a question for you. Looking ahead, what's your real goal? Is it the lottery ticket, the thrill of a big win? Or is it about building a solid, repeatable process that will keep you in the game for the long haul? Because that's the choice that will determine whether you're still here in 5 or 10 years.